everyone. Thanks for joining me today. Today we are going to talk about the new student loan repayment plan called SAVE. Before we get started, you might want to know who is talking to you. My name is Tina Herndon. I am a financial educator here at Tinker Federal Credit Union, TFCU, and I have a long history of counseling clients about their student loans, whether it be public service loan forgiveness, how to repay your loan at the lowest amount possible for the shortest amount of time possible. These are the kind of strategies that I helped people create for over a decade. Let's start from the beginning. Student loan payments have been paused for the last 3 years. So let's talk about why. Well, it was due to the CARES Act that was a COVID relief response, and it started in March of 22. And what caused this? What was paused? Well, it was payments, collections, and interest. And borrowers could pay while paused, but they didn't have to make their payments. And it's important to know that not every loan type was included in this payment pause. So now you may be wondering, well, what ones were included in the payment pause? Well, here they are. They were all of the federal direct loans, the graduate and plus parent loans. And they were paused unless they were consolidated or unconsolidated, as long as they were not privately consolidated. Direct student loans that were in collections also were paused, and the collection was actually paused as well. And this happened whether you are on track for forgiveness or not. It really didn't matter. It was any of these types of loans. So what loans were not included? Well, the private student loans, those were made by individual lenders, and they didn't tell them that they had to pause those payments. Some FFEL student loans, we call those FEL loans, and those are the old types of loans before the year 2010 and the rules changed. So now that you know what was paused, here's a timeline of the history of the student loan payment pause. So the payment pause began in March of 2022 when COVID was at its peak at the very beginning, and we were unsure what was going to happen from that point. Then in 21 and 22, the pause has been extended all the way into 2023. But that payment pause is coming to an end September 1st, and the payments will be due starting in October. So arrangements need to be made, contact information should be updated, lots of things that we could do right now to make sure we don't miss anything, and that we don't miss that payment, and that we don't miss an opportunity as well. Federal student loans are different than any other type of loan because they have a lot of different options for repayment. However, if no option is requested, then you automatically are put into the standard repayment. And standard repayment means it is a 10-year loan with equal monthly payments for that entire 10 years. But that payment's not affordable for every household. And if it is not affordable for you, I encourage you to look into an income-driven repayment plan. So you may be asking, what is this IDR thing? Well, it is a repayment plan that calculates your payment by considering your household size and your income. So your payments are automatically adjusted, and most of the time they are going to be less than the standard repayment. And is there more than one kind of IDR? Yes, there is. There are actually 4 different IDR plans: income contingent repayment plan, income-based repayment plan, pay, and we used to have repay, but the new SAVE plan has replaced repay. And repay was a very popular option, but SAVE tends to be a little more budget friendly for some folks. So you may be wondering, what is different with this new repayment plan? Well, there's quite a few differences. The zero payment has been broadened. The affordable payments are a little bit less. Accumulating interest is handled in a different way. The capitalization of interest has been eliminated mostly. Spousal income assessment of how much of their income contributes to that payment, that's changed a little bit. Certification of income has also changed. And earlier forgiveness for a lot of folks. And so we will talk about each of these changes in depth. First, there's the $0 payment, and that literally means your payment is zero. So you don't really have to make a payment. So what is $0 payment? The borrower's income is determined to be too low for any payment to be affordable. Therefore, they set the payment to zero. Who qualifies for this $0 payment? Well, they have raised it to 225% of the U.S. Department of Health and Human Services poverty guidelines. So here's an example of incomes for 2023. So if you're a single person and your adjusted gross income on your taxes is less than $32,800, you qualify for a $0 payment. And for a family of 4, that would be $67,500. So I talked about an affordable payment option, and right now through the Repay program, all of the payments are set to 10% of discretionary income, but the affordable payment actually makes it a little bit less with the SAVE. It can be 5 to 10% of your discretionary income. 5% if it's undergraduate loans, and 10% if you have graduate loans. And if you have both graduate and undergraduate, it's a weighted average between the two. And discretionary income, you might be wondering, what in the world? How do they calculate that? Well, that is your adjusted gross income from your tax return, your 1040, minus 225% of those poverty guidelines for your household size. And then they determine your payment is 5 to 10% for the rest of that, for the rest of the income. So let me explain, let me just show you this. A payment example for a 4-person home with undergraduate loans in 2023. So if your household income, let's say, is $100,000 between everyone, so that's your adjusted gross income on your 1040 tax return. 225% of poverty is $67,500, so we're going to subtract that from your income of $100,000. So your remaining, your discretionary income is $32,500. And so I'm going to take that $32,500, figure out 5%, which means you're going to make a payment of $1,635 within a year. So all of your monthly payments should equal that amount. But your monthly payment, I'm going to take that divided by 12, should be $135.42. It should be very, very close to that. Decimal points may make it a little bit off, but this is what your payment should look like. And that's how it's calculated. So now let's talk about the spousal income assessment. So with the old rules, under the Repay, all household income is considered for payment calculations, regardless of how you file your taxes. But with the SAVE, married filing separate will not use spouse's income for payment calculations. But let me put my counselor hat on and say, please consult with a tax professional before you decide to change your filing status. It can cost you. It really can, because some credits and deductions are not available if you're married filing separate. But it could reduce your payment if you're just the right type of client. On the old Repay program, interest would continue to accumulate even if your payment wasn't big enough to even pay anything toward that interest. So what a lot of people, especially people with zero payments, their balances were just ballooning out of control, and there was a lot of anxiety about seeing those balances grow. Well, the SAVE program takes care of that. If payments are too small to cover both principal and interest, interest does not accrue. It's just not charged for that month. So let's look at an example of that. So if your standard repayment would be $300, that's a standard payment. So if you're on that 10-year plan, but on the save payment, we're going to save $100 there. Now these are made up numbers. So if the normal payment, so the standard repayment, would break down to $250 of principal and $50 in interest. Well, that interest on the old plan would still be charged, but with the new payment, the actual payment breakdown would just be $200 going to principal and then $0 going to interest. They just won't charge that. So that way we can make sure that our payments are actually decreasing our balance no matter what our payments actually are. Under the old repay program, interest was allowed to be capitalized, and so some loan events, like a consolidation, would trigger interest to be added to the principal balance, so it would just increase that principal. But with the save rules, that interest will no longer capitalize on loans. So that can be really confusing, especially if capitalization is not a word that's normally in your vocabulary. So let me break that down a little bit. So let's say we have multiple loans out there, but we want to consolidate them into just one using the federal program. So here is a consolidation interest example. So let's say your principal balance is $50,000, and because that's how much you borrowed, and we haven't made any payments yet. On any of those loans, you still owe the $50,000 in principal balance. But while you were in school, $4,000 accumulated. So now, when they capitalize your interest, your principal balance is going to be $54,000. And then interest will keep being accrued on $54,000 instead of $50,000. See where that can get bigger? So now let's look at the SAVE program, where interest doesn't capitalize. If you consolidated them now under the SAVE program, your principal would still be $50,000 and you would still have $4,000 that you owe in interest. So the reason why we don't want them to capitalize is because you are charged interest on your principal balance. So when they capitalized and they added that $4,000 to the principal, now every month you're paying interest on $54,000 instead of $50,000. So this can really help to control that debt and keep it from getting out of control. Certification of income is another thing that has been changed. So under the old repay, borrowers must recertify income manually every 12 months. So you would have to upload your tax return and fill out a questionnaire, and you would have to send that back every 12 months. But with the SAVE rule, if you give the Department of Education permission, you can use the IRS retrieval tool, and that will eliminate the need for that annual recertification. What will happen is when you file your taxes, the Department of Ed can see that, and then they can use that to make sure that you're not making too much money and you still qualify for that payment. Or maybe your payment needs to go down because you've had a reduction of income. Whatever that looks like, we want to make sure that they're doing that. So why was income verified? It was just to adjust the payment based on your current income status. Because if you used to make $50,000 but you got your dream job and now make $100,000, it is not fair to anyone that you're still paying on the income-based repayment plan that lower payment. So that is why they would look at that. So how does this help? It ensures that payments are not reset to standard due to the return of paperwork. What would happen is if you did not certify your income, then it would go back to the standard repayment, which in a lot of cases was significantly higher and completely unaffordable, which is why they were on the income-driven repayment plan in the first place. So can Department of Ed see income without permission? I know we want to make sure that we are protecting our privacy, and no, borrower must consent before Department of Ed can use that IRS retrieval tool. Some folks may see earlier forgiveness with the SAVE program, and here's why. Under the repay rules, loan balance was forgiven after 20 to 25 years of payments, depending on if they were undergraduate or graduate payments. But with the SAVE rule, if the original loan balance was $12,000 or less, forgiveness is after 10 years of payments under the SAVE program. And then if it's more than $12,000, for every $1,000 more, it's one more year. But there is a maximum of 20 to 25 years. That's why I say some people may see earlier forgiveness. So here's an example of that. If your loan balance is $16,000, and that's how much you actually borrowed, your original balance, your forgiveness would be 14 years because it's 4 more years than 12,000. So will SAVE increase my income the year it is given? I just wanted you to know, yes. Please consult with a tax professional before forgiveness to minimize the impact of that additional income, because that can really hurt us if we're not prepared for it. So now that you've heard all this great information, you are probably wondering, how in the world do I apply for this program? Well, I'm so glad you asked, because I have those answers. The first thing you want to do is go to studentaid.gov. This is a picture of that page right there on your screen right now, and then you'll just click the login. And if you don't have your password, don't worry about that. You can retrieve your password. But I do want to make sure that you have your phone or email available, because they do have a 2-step verification process. So you will need either your email or your phone, whichever way you choose to verify, but they are being very careful in making sure that they keep your information safe, safe, safe. Then you'll click on loan repayment, income-driven repayment, then apply for income-driven repayment. And that is about a 10-minute process. So make sure you have plenty of time. May take some folks a little longer, some folks a little less time. But also you may need your tax returns. If you choose to use the IRS retrieval tool that we talked about, you will need your adjusted gross income and your filing status. So make sure you have that 1040 available so that you can get that information when it asks for it. Well, I hope you have enjoyed this webinar and you have found it useful and now understand this brand new repayment tool just a lot better. But I do want to leave you with a couple of resources. First one is for our members. As a benefit of membership, TFCU's Member Solutions team offers free financial coaching with their certified financial counselors. And that can be on a broad range of topics. Maybe you need to find some room in your budget to make this payment. Maybe you want to increase your credit score, or maybe you're wondering about debt consolidation or something like that to also help make room for this payment. If those are questions you have, you can set up a one-on-one coaching session with one of our certified financial counselors by calling the phone number or emailing the email address that's on your screen right now and setting up an appointment for them to meet you at a branch that's closest to you, virtually or over the phone. If you are not a member of TFCU, we have a resource for you as well. Our partner Balance is a financial education and counseling service, and they can meet with you. TFCU will pay for you to have financial counseling. So just let them know that Tinker Federal Credit Union sent you when you call the phone number on your screen right now. Also want to draw your attention to the web address that you see, tinkerfcu.balancepro.org. On that website, you can find lots of reliable information in whichever form you choose to receive it. There's articles, podcasts, videos, toolkits, calculators, even classes that you can take online, and all of those resources are completely free for our community members. The last resource that I'm going to leave you with is our team, my teammates and me. If you would like to schedule a virtual or in-person workshop for your school, your organization, your business, we want to be anywhere that 10 people or more gather. So just call that phone number or email us, and we would be happy to set up a time to talk about what you want us to present, or maybe we even create an experience for you. Thank you so much for spending this time here with me today, and I hope you have found this to be beneficial and that you're walking away with more knowledge than you came in with. I hope you have a great rest of your day. Bye.